crisis that we saw on this island at 777 Re is something that's unnerved some regulators about the kind of credit, liquidity, counterparty risks in life reinsurance. And we've seen tightening from regulators in Bermuda, but also in ceding jurisdictions, the NAIC in the US and obviously the PRA in the UK, over offshore funded reinsurance or asset intensive reinsurance. It's very much the big question of the day. Like, Jeff, how is this affecting the life re sector right now and your business? How are you responding to that?
Yeah, so it's been an interesting time. I think that if you think about reinsurance overall, it's been global, and there's more and more, and all of us want to, like most global reinsurers, want to act everywhere in the world. And covered agreement allowed, U.S. companies to do business in Europe and vice versa. Bermuda was part of that. And as soon as the agreement was signed, there was some nervousness. I would say some of the regulators are not trusting each other. And obviously, we heard this morning $1 trillion of asset has moved to this island. And it's not just this island. There's a lot of offshore reinsurance of large block of life business. And so I think the fear of the regulators everywhere is what does that do? And is the counterparty good enough, and is collateral good enough? Basically, people are doing this because you're getting assets invested in different categories that maybe you're not allowed to do in the US or in the UK. And as a result of that, I think there's a bit of a fear from the regulator saying, well, what happened to that reinsurance agreement with a $2 billion of capital company, but the collateral collapsed, and is there enough money there to help continue the collateral going forward, or is the company that's ceding this business having to reinsure it? So I think the reaction we see from the regulator is normal. I think what you should expect that when this much business transferred. And so the fear is the company with two guys, a dog and a computer, and $2 billion of capital, right? Like there should be more substance behind those companies. And I think that's what we see in Bermuda. The regulators are saying, well, you got to do your asset adequacy testing. You got to do your Solvency II type capital testing. And I think in the long run, it'll be good for Bermuda and for the market.
Oh, yeah. How do you think it will change the sector? Obviously, those two men and a dog to Cayman instead.
I think so. I think that's what's already happening, but I'm not sure if that's a long-term viable solution. I think for most of us who are global reinsurers who want a bit of a fair play and a bit of the same sort of rules for everybody. They don't have to be the rules. There's a little bit of arbitrations between the rules, but I think in the long run, Bermuda will still be where it's at today and strive. And the stronger companies that are putting the process in place are going to be there in the future.
But as you say, as you put it, the regulators are turning on each other. They're obviously asking more questions of each other and looking over each other's shoulders, perhaps. How is that going to change? Do you think we'll see more divergence between the different kind of regulatory regimes that's going to make it more problematic to do the offshore business? Or how do you see that playing out?
Yeah, it's a good question. Like I mentioned, the regulators don't really trust each other. So I think what we're going to get as a result of this is a bit of protectionism, right? Like everybody wants more capital in their jurisdiction. They want more control over the transactions that are being done in their jurisdiction. So you see the PRA asking for diversification of reinsurers. They're asking the ceding company to test whether or not what happens if the reinsurer fails and you're getting back those assets. And at the same time, the U.S. regulators are doing the same thing. They want to pass an asset adequacy testing that will make the ceding company assume that the assets that are with the reinsurer come back to you. So those kinds of things are just, there's not a whole lot of trust. And for global reinsurance in general, it's not a good thing because we like to diversify. We like to use our, the longevity gain that we have in the UK during COVID, offset some of the mortality loss we have in the US. So if you're going to have to put more capital in each of the jurisdictions, it means you have less capital and essentially less capacity. So I think that could become a long-term problem for some of the global reinsurers.
I mean, and a related theme is obviously we have a new breed of owner of life reinsurance companies, or either being owned by or linked to big kind of private capital groups, including some big players on this island. Is there any concern that you have around that the life reinsurers are investing in things that are actually for the benefit of the ultimate annuitants, policyholders, as opposed to the interests of the owner or the linked party?
That's the fear the regulators have, obviously.
But is it a kind of genuine fear? Because obviously these owners have added a lot of capital to these groups over time. They've come in at a time where the traditional life insurance sector has really pulled back and not wanted to put capital against long-term financial guarantees. So, they've stepped forward and, just to give you the challenge on that, how do you come out on it?
No, I sort of agree with what's happening. It's questionable whether investing in Everton Football Club is a good investment in your...
There are other football clubs.
Yeah, yeah, exactly. But I think that's the problem, right? Are the assets adequate? And I think that's why Bermuda is doing the right thing in making sure that we're going to test those things. I think if the regulators don't do this job, it could create some serious problem. These PE firms, obviously, are all going in and doing hopefully the right things, but some are well run and some are questionable. And the question becomes, how do we work with that in the long run? Are we trusting the regulators? Do we, as an industry, trust that everything is going to be done well? And it comes back to, even in the U.S., the NAIC, I'm not sure the Massachusetts regulator trusts the New York regulator who doesn't trust the California regulator. So you have the same problem. They all agree to these transactions being done, but then they don't trust the next guy to agree to the right transaction. So we need a bit more.
It didn't seem totally, with the 777 Re situation, that they were on top of the transactions that had been done very much by the US state regulators, then trying to catch up on the level of exposure within that, within their domestic insurance group that was exposed to 777.
Yeah.
So they've played catch up, it's fair to say.
They are. There's no question. They're looking at different ways to do it. Asset adequacy testing is one way, but they want to look at the capital of the group a little differently. They're trying to come up with 3 or 4 different ways to address this issue. And it's a tough issue, right? Like you can't say to the regulators can't say, we're just going to look at PE firms, because it's hard to define, right? Like there are some PE firms or reinsurers that started as PE firms that have been around for a long time, have had success, are doing all the right things, and I would qualify them as normal reinsurers today. They do a really good job. And there are some newer firms that are all about, the shareholders, and so you have to worry about this. And I think,
is there a risk that, we're going to hear from the BMA shortly, but is there a risk that by cracking down tightly on connected party investments, affiliated investments made by life reinsurers that are linked to or owned by private capital groups, I'll get to the end of my question in a minute, that they go too far, and actually that model that we've seen be very successful within Bermuda, people start to say, well, I'm not sure if it makes the same amount of sense if there's going to be this degree of, crack down on the kind of way that I...
Yeah, I think the strong players will succeed and the weaker players probably won't. What you're bringing here and what the BMA is trying to do is to make sure that they're protecting the reputation of the island. It's a really good reputation. They should be continuing to do well. But there's more protection, even on the tax side. Global minimum tax, the BEAT in the US. So related party transactions are being looked at in a different ways. And I feel it's not all related transactions that are the problem. That, like most of us global reinsurers, we want our capital to be strong in one place and then feed the capital in a different place and have some internal reinsurance to protect the companies that we have in the various countries we do business in. So that model works really well. It's a global model. As the regulators are coming down on these related party transaction, it's going to affect the global reinsurers in a way. And you have to put more capital in those countries. It means you have less capital in the mothership, and you can do less.
Yeah. It's just kind of broadening out for my next question. How do you think the life reinsurance sector is going to respond to this kind of higher for longer interest rate environment that we're now in, right? We've seen a significant kind of backup in yields, and it does seem that, you know, not to get into a discussion of the neutral rate, but it does seem people are getting kind of gearing up for like a higher level of interest rates for longer. How do you think that will change the business?
I think most life insurers or life reinsurers want higher yield, right? Like we've been in a downward trend for a long time. The problem that we've all had is that it's gone up so quick during COVID that people ended up looking at a lot of unrealized loss in their portfolio, and that's been a problem. If you have lapse, if you have a change in your liabilities, obviously that puts you at risk. But long term, I think higher interest rates are good for the life industry, and so I think what you might see again is a bigger amount of fixed indexed or fixed annuities. So people are going to offer products, saving products, that are going to be a bit more attractive to the policyholders.
Yes. You do obviously have a P&C business too. What's your feeling coming into kind of January 1? How much the kind of hurricanes Helene and Milton have changed the picture on pricing for property cat?
Yeah, I would say last year was the best year I've ever seen in terms of condition. We're mostly a retro on the nat cat side. We do some structured business to help clients as well. We're a big life direct operated company, AA rated. So we offer nice big capital and diversification, right? Like so people want us on their panel for that reason. And last year was probably the best year. The feeling was that rates were probably going to come down a bit, but after Helene and Milton, I'm assuming the conditions will be the same as last year. The conditions are good, and they should be good. This industry's paid a ton of money in claims in the last 7 years. I think it's about time that the rates are where they should be.
Something we talked about in the prep call, one of the things you find you've looked at and worked on is kind of how to best attract talent, you know, getting people to even have heard of life reinsurance and then get them to want to work in it. You know, where have you had successes there that maybe the audience would find?
Yeah, talent's important. I mean, if I ask people here who out of university wanted to be in the life or in the insurance industry, right? Like nobody dreams about being in the insurance industry. There was an Esurance commercial a few years ago with Dennis Quaid saying insurance is not sexy, it's not delicious, and it's not fun. And if all those things are true, and I believe they're true, it's hard to attract talent, and yet we're all here. You
get to try and buy Everton Football Club.
Obviously that helps. But, so you need to attract the right talent. I think Stephen this morning talked about some of the quality and some of the things you're looking for people. I'm looking for we people, not for me people. I think I want us to hang together and not hang separately. So it is important to have a good team that are thinking. The team's working together, and I want everybody to feel part of the team, whether you're working on the administration of claims or whether you're working on the new transactions we're putting in. Everybody's important, and it's important as a team leader to tell them what winning means, right? Like we've got a team, everybody's a we person. What are the goals in the year? And they can't be just financial goals. They have to be what projects are we doing on? We do a lot of sustainability, and I get people involved personally. I don't want to just give money to charities. We want to participate in this. We've had a lot of success, and it's very good. I think when young people are looking, and I would say that most of the young folks right now, they're looking to change the world. They want to do something that's very important. And this industry is very important. Right? Like it's something we forget to mention. Like, we help people when they lose loved ones. We help people in catastrophes, and we help families all the time. And yet, for some reason, we don't have a very good rap. This is a really honorable industry. What we do for a living is very important. As a reinsurer, I don't get examples of that. So I bring some of our clients to tell us how good we are as an industry, to explain, to make sure that my people understand that. I think you do that, you get a lot of buy-in to what we do. I think we should all be proud of what we do.
I want to give the audience an opportunity to ask a question. Do we have any questions from the floor? Oh, I've got more. I always have more. Are we sure? Okay. I want to ask you about changing demographics. You know, aging societies. How do you think over time is something maybe we don't talk about as much as some of the other long-run trends? You know, how is that going to change, or is changing the life reinsurance sector?
Yeah, I think more in the U.S. right now, more people are going to retire this year, next year, and the year after than ever, and then it's going to start dropping again. So it's the end of the baby boomers. The life insurance industry has followed the baby boomers. When I was a young actuary, we were pricing protection products only. Then it became protection and savings. Then became mostly savings, and now we're in the retirement world. And so the demographics have changed. Like, we're following the money. That the baby boomers have the money, we're following the money. What it means, though, is a lot of pension plans are de-risking. Longevity is becoming more and more of a good market for the life insurance industry. We're a normal place to go to take on the risk of longevity. So our company does a lot of it, and I think it's been good, and it's been going for 10 years, and it's going to keep on coming. There's going to be other factors. I mean, people are withdrawing money now. They've been saving for a while. We've had a nice long stock market rise. I think people are going to start taking their money out of the table. You see most of the pension plans are on a declining mode in terms of there's more outflows than inflows. I'm not sure what that's going to do to the markets in the long run. It's an interesting question.
Yeah, remove some of the bids for kind of government bonds.
Yeah.
But, you know, it means for ordinary people, we're all being forced to take more investment risk, aren't we, ourselves, over the longer term, defined contribution pension plans, and we have environment of people living for much longer, holding investment risk for much longer. You know, what role should the insurance
Yeah, like the people older than me are all defined benefit.
Yeah, we'll try not to resonate.
Right? Like, but we have to take care of ourselves now, and so it's a different game. You're right, and as an industry, there's an opportunity there, right? We could sell payout annuities when people retire. I think in England, you've done a better job of doing that. In the U.S., people are reluctant to do that. But some of the newer products have some features that are helping people at least getting a minimum income over time. And I think that's the big potential future for the industry.
We're almost out of time. Does anyone have one question? Tempt anyone? I'm going to slowly look.
Very clear.
Okay, well, just thank you. You've covered everything.
All right.
Please join me in thanking Jeff for a really interesting conversation.
Thank you. Well done.
Appreciate that.